Hi everyone, welcome to Dot Point PS5, and today we're looking at using techniques to analyze the financial situation of a farm enterprise, including calculating gross margin and return to capital. So these are the only two financial things that you'll need to do or remember. So if you get asked a question about anything to do with financial situation of a farm, it's either gross margin or return to capital. Sometimes they might ask a question about both. So let's have a look at what we need to do here. Return to capital is also sometimes known as return on capital, but both of them are ways that we can analyze the financial situation of a farm. And so they're kind of a form of budgeting. And so obviously farmers are going to budget because you want to determine the optimal rates of production, such as whether to use fertilizer or not, calculating the profit from different farm practices. Obviously you don't want to do things that are going to cost you more money than you're going to make. You also want to determine the advantages of adding additional enterprises, such as doing sheep as well as wheat, or doing barley instead of wheat, or something like that, or changing combinations of enterprises. You also might need to work out, is it better if I hire additional people? Will I make more money out of that, or will it cost me more money and I won't make as much return? Also assessing the profitability of whether expanding the farm might be a good idea or not. So the first one, and the one that comes up most commonly, is called gross margins. And basically, a gross margin is a way that you can compare between two different enterprises or two different methods of producing the same thing. So, for example, you might compare between growing wheat and barley. You might compare between growing sheep and beef, and you'll work out what is the best, most financially rewarding enterprise to do once you've calculated a gross margin. You also might choose two different production methods. So for example, you might choose, is it better for me to do cotton or irrigated cotton? So non-irrigated cotton versus irrigated cotton. Which one is going to make me more money? Because obviously there's more costs involved with irrigation, but will the extra yield be more than covering the extra cost of irrigation? So basically, the thing you need to remember for gross margins is the equation for a gross margin is the total income of that enterprise minus the variable costs of that enterprise. And in short, the variable costs are things that are directly linked to the enterprise that you're doing. And they are variable because they vary with the size of the enterprise. So if I am growing cotton, or if I'm breeding beef cattle, then the things that I have to pay for and I have to spend because I'm doing that thing are variable costs. Anything that I have to pay anyway are what's known as fixed costs, and you don't include those in gross margins because they don't change. Whether I grow lots of beef, not much beef, or no beef, or whether I grow cotton or wheat, I still have to pay the fixed costs. So they are not included in a gross margin because it simply takes too much time to include those, and it doesn't tell you anything extra. So examples of variable costs would, for crops here and livestock here, variable costs: seed, fertilizer, sprays, fuels, repairs, contract harvesting, casual labor, and cartage. All these things will change if you produce more or less of a thing, and so they are variable. Examples for livestock are grain for feeding, haymaking, drench and vaccine, shearing and crutching, casual labor, vets, cartage, and shed repairs. All those things will change depending on whether or not you have animals. Examples of fixed costs which you do not include in a gross margin include administration and accounting, rates and rents, depreciation of machinery, general farm insurance, interest payments, permanent employment, taxation, repairs to roads and buildings. All these things are going to have to be paid no matter what, whether you grow a crop or an animal anyway, and whether you increase it or decrease it. And so those things are fixed, and you don't bother including them in a gross margin. It's important here to note that gross margins are usually calculated per hectare or per animal. So with animals, it's important to know how many animals you can incorporate onto an area of a hectare to compare it to crops. But sometimes you'll just work out the gross margin per head or per animal if you're just doing animals or just comparing animals. But basically, it's important to know that 1 hectare is 2.47 acres, or a hectare is 10,000 square meters. And 1 acre is basically 80% of a football field. So an example here for a gross margin of a 50 hectare wheat enterprise, it's already given us the total income, and the total income is $2,700 for our wheat. And then all of the things that I've listed here are all variable expenses. They haven't given us any fixed costs here. So equipment repair, seed, fertilizer, sprays, fuel, insurance of the crop, which you wouldn't have if you didn't grow the crop, harvest, and then rail cartage, which means transport. All those things you need to add together. So you have $2,700 income minus all of the variable costs added together, which gives you $1,875, which works out divided by 50 hectares to give you $37.50 per hectare gross margin. Now that's not profit, because out of that needs to be taken fixed costs as well, like tax, permanent labor, and all the other fixed costs, but the gross margin is $37.50. Now, if you compare that to barley, you might get a different price from barley, you might have a different yield, and there might be lower costs. And so let's say hypothetically the gross margin per hectare might be $60 for barley, in which case it might be better for you to grow barley. So once you've calculated a gross margin, you can compare it to other crops such as barley, as mentioned, and then you can also compare it to other farms in the area and see if it's costing them more or less, if they're getting a better gross margin per hectare. And so advantages here of gross margins are it's an accurate comparison of different enterprises such as wheat and barley. It's quick and simple and allows comparisons between other farms in the area. However, disadvantages are it isn't a measure of profit because it doesn't include tax and fixed costs. So here we've just got some other gross margins, and I've gone through this list here and put fixed or variable next to these costs. Cartage here is transport. Permanent employees is a fixed cost because you have to employ them and you have to pay them even if you're growing wheat. If you're not growing wheat, if you change to barley, you have to pay them because they're permanent. Whereas casual employees, if you are just getting people in temporarily to harvest things, you don't need to pay them unless you employ them, so that it would be variable, but permanent employees are fixed. And so I've listed variable and I've listed fixed here. So if you work that out, you've got a yield here of 3.5 tons at 125 a ton. That's your income. Then I've added up here all the variable costs, 2.2 hours at $15.25 an hour. It's given you $33.55. You just need to multiply these things and work out the totals. Harvesting, cartage, which is transport, which gives you a total of $269.45, which gives you a gross margin of $164.80 per hectare, because remember, this was all done per hectare. This is another practice of gross margins. It also has a return to capital in it, and this first section, number 1, is all the capital or money invested, and then you work out the return. And you put the return over the gross margin, over this capital invested, and you get the percentage of 6.88%. But here we have anticipated income. You add these things up because we're doing beef cattle. Once you add up the income, it is $91,700. And then once you work out the total costs, $38,250. And then once you take away the income or the costs from the income, you get a gross margin of $53,450, and you put that over that return over the capital invested, and the return on the capital is 6.88%, which is quite a good return. If you put money in a bank account, you'd get about 4% return, 3% return. So 6.88% return is quite good. This is another example of a gross margin here for a 1,000 hectare property. And basically I've just done, I've excluded the things, because we're doing a gross margin for prime lamb production, I've excluded the things that don't relate to the prime lamb production. And then I've excluded all the fixed costs down here as well. And just included sheep husbandry costs, casual labor, the things that are variable, I've included those for $44,580. The total income was $115,200. So you subtract $44,580 from $115,200, which gives you $70,620. And if you divide that by per ewe, because there's 3,000 ewes, it says up here, divide that per ewe, it's $23.54 a ewe, or if you divide it by 1,000 hectares, then you get $70.62 per hectare. This is another example here of calculating gross margins. So why is it important? Which important piece of information would you require if you're going to compare gross margin for prime lamb production and gross margin for irrigated wheat? You need to know what's known as the DSE, or the dry sheep equivalent. And this means how many sheep you can have on a hectare that are not pregnant, which is also known as a stocking rate. So you'd have to work out how many animals you can have per hectare if you wanted to compare it to wheat, which you're obviously going to work out per hectare. Moving down here, this is an example of a gross margin at a low price with a low harvest or low yield, compared to a higher price double the price with about double the yields, or almost triple. And the difference between them in the gross margin is $3 compared to $975. So there's a $972 per hectare difference in the gross margin depending on the price that you get and the yield that you get for wheat, which is significant. So return to capital, this is where you work out your profit basically over the money invested, and you times it by 100 to give you a percentage. So for example, if you had a bank account and you invested $100 in a bank account for a year and you're getting 3% interest, you'd get $3 back on your $100 each year. So at the end of the first year, you'd end up with $103. And this is known as the return to capital because it's in that case that I just gave you, 3% is the return on capital because you've invested 100, you've got back 3, and so that's a return on capital of 3%. And so in farming, we want to know if we've invested $1 million in equipment to expand our dairy and it only gives you a 2% return to capital, is it better for me to just put that money, that $1 million in shares on the stock market, which might give you, say, a 6% return to capital? So capital is basically the money that's been invested in something, which you can usually return. So if you buy new land and you spend $1 million on that land, that's capital because you can get that money back. However, if you can't sell that thing, then it's not considered capital. So ongoing expenses, if you have to buy drench or you have to buy feed for your animals, you can't sell that afterwards and make the money back. So it's not considered capital expenditure. So capital is anything you invest in which you can then make money out of in the future. So advantages of return to capital, it helps producers decide what return is better or what investment is better, and it's relatively easy to calculate, but it doesn't factor in intangible reasons such as a family history in dairy farming. You might only get 1 or 2% return in dairy farming, but it may be something that they've done all their life, and so that's why they're willing to invest money into dairy farming even though they're getting a small return to capital. All right, for this past HSC question from 2017, it's for 175 hectares of breeding cow production. So you need to add up the income here, and it's already done for you actually, and 63,200 is the answer. You then need to choose which ones are fixed and which ones are variable. So if you're growing cattle, veterinary costs obviously variable. Tractor leasing, you have to pay that no matter what, even if you don't have cattle or you do. So that's fixed and you don't include that. Fodder costs is feed costs and you include that. Pasture maintenance, if you didn't have cattle, you wouldn't have pasture, so that is included. Land rates, you'd have to pay anyway, so you don't include that, it's fixed. And lastly, selling costs, of course you do include because you only pay that if you have cattle. So if you add up that one, that one, that one, and that one, you get 21,560. The total gross margin is this one minus this one, which gives you this one. And then lastly, it's 175 hectares, which you divide that by 175 to give you 237.94. This one is from 2010, and it says the table shows the information for 2 crops, and then it says calculate the gross margin per hectare for the crop with the higher yield. Now, some people make the mistake of doing the wrong crop and getting it all wrong, but it says yield per hectare 3 for this one's 4 per hectare. So clearly this one is the one with the higher yield. So you need to do crop B. Crop with the higher yield is crop B. The income is 4 tons per hectare and getting $150 per ton. So it's 4 tons a hectare times 150 per ton, which gives you $600 income. Now you need to only include the variable costs, and this is obviously chemical, seed costs, and then fertilizer costs. You don't include Shire Council rates because they have to be paid anyway. They're fixed, and bank interest charges, they also have to be paid anyway, so they are fixed as well. So once you add those up, you get $170. You get 600 minus 170, which gives you $430 per hectare. In 2011, there was this multiple choice question: which of the following is most useful for farmers when analyzing financial situation of a farm? The answer is gross margin. Here it says discuss the use of gross margin budgeting in business management. So I've given you an outline of what gross margins are and how you calculated it. And then I've given positive and negative, and I've clearly included those as positives and negatives to discuss here. And I've given sufficient information because you need to give detailed points. So I've done that there for 5 marks. In 2013, there's a question: which financial management technique provides an accurate comparison of the relative profitability of an enterprise? Now, Gross margins don't show you profit because they don't include tax. So I think this question was worded poorly, and it would be better if it said comparison of the relative margin of enterprises on a farm. And the answer in that case would be gross margin. In 2014, the question asked was assess the effectiveness of techniques. Now, as soon as you see an S there, you should realize that you have to do more than one. And so I've made it really clear here for the markers and said 1 and 2. So they know straight away that I've done 2. And then I've underlined each one so it's clear what they are. The only 2 in the syllabus are gross margins and return to capital. So clearly it's going to be those 2. You need to assess how effective they are at analysing the financial performance of farms. So I've basically talked about them, what they're used for, how you calculate them. In both cases, I've given the formula, and then I've assessed it. So you'll see I've written very effective, and why they are very effective. So I have comprehensively assessed, rather than just comprehensively assessing one. I've comprehensively assessed both of them. I haven't outlined any. I've comprehensively assessed them to get 6 marks there. In 2015, question was, which of the following should be subtracted from total enterprise income to calculate a gross margin? It is, of course, variable costs. This one here, which requires calculation, a farm grows out 100 steers for a beef feedlot, an extract is shown. You need to remove the fixed one here and calculate it, and it gives you 250. And then lastly here, this is a financial information from a farm from 2017. What is the return on capital? So once you add up the land value and the livestock and machinery, these are capital expenses because all these things could be sold and you could make the money back off them. So that's what capital is. So this gives you 3.5 million. And then basically you need to work out the over the 3.5 million, you need to put the profit from the farm each year to work out the return to capital. So you have to actually work out the cost of the farm and then subtract that from the profit, and that gives you 260,000. So remember that return on capital is basically income minus costs equal profit, and you put that over the capital. So return, this is return or profit over the capital, these two things, and it'll give you 7.4%.